What do you think? Are we in for a decline in the markets based on historicals, or is there something else that could push this market lower or maybe keep the rally going?
I don't know. I think that we've come a long way in year to date in all the averages, so it wouldn't surprise me if we took a pause. But I'm encouraged by the economic data that we're seeing and how that's translating into earnings being a little bit better than expected. So if you look at the economic data, we got the GDP numbers last week, 2.4 versus 2% in the first quarter. So an acceleration, right? Led by the consumer. We've talked about the consumer endlessly all year, supported by jobs, supported by wages, and even the JOLTS number today. I know people are kind of encouraged because it came down. You still have 1.6 jobs available for one unemployed person. So consumer is doing just fine, and I think will continue. Manufacturing, it's a little bit different, right? It's a little dicey, but I think the PMIs are bottoming at this point, especially on the regional series. So I think the manufacturing side of the economy certainly could be the surprise in the second half of the year as it kind of gets a little bit better. Durable goods really encouraging last week as well. And at the same time, we all know that inflation is coming down. So all of this wrapped up is leading to a little bit better than expected earnings and a broadening of the market. And if you look at some of the industrials, for example, they've really been stellar. They're putting up about 7-8% growth. The financials are put up about 8%. Banks put up 19% earnings growth. So it's not just tech, and I'm encouraged by that. And if we can continue to see the broadening in the marketplace, I actually think that might carry us higher, these other industries. So I'm encouraged. All
right, so a lot of encouragement there. Jim, we hit the historical data over the last almost 30 years. The Dow seeing a decline in August, worst month out of the year. Is that meaningful in today's environment?
I think it is. By the way, September's no gem, Frank. I mean, that's really, kind of not a good month either.
And October.
October's not so bad. It gets a bad rap because of 1929. But let's not get stuck on that. Look, and especially when you've had a year like this where the market's up, the S&P 500's up 20%. Now, you got to decide how you want to deal with that. You could take some money out of the market. I do not think it's wise to get wildly out of the market. I've raised some cash recently. I've got about 7%. Steph, you made a great point that another way to deal with that is maybe take some money from the high-flying tech winners and put it into some of the things that you and I have liked for quite some time, the more cyclicals, financials, industrials, materials, and energy, and kind of hide out there. Let me be clear that what I'm saying is not scientific. Okay, there's nothing, I can't prove this to you. This is just experience that probably, this rally is going to run out of steam in the next couple of weeks. Consider, Frank and everybody, consider that next week you got the CPI. What if, I'm not saying it will happen, but what if it has a 2 handle on the headline, right? That would indicate that really the Fed should be done. I think the market's priced that in. I think it's hard to get more good news into this market. It does not mean sell all your stocks and, head for the hills. It just means be a little tactical here. In the long run, things look very bright. These 3 infrastructure bills that we've had over the last 2 years, they really don't start hitting until next year through 2026. Those are going to be powerful economic drivers. So you don't want to really be out of this market, but you can be a little tactical around the edges.
Liz Young, are you looking at that historical data? Is that meaningful in today's world as we see the markets decline on the first trading day of August?
I mean, it's absolutely meaningful. You always have to look at history and find out what investors typically do after a big run up like this. And to Jim's point, we've seen such a strong rally. It's natural for some of the steam to come off of that. But I think what we're going to see, and what a lot of the minds have changed to come to believe, is that maybe an Armageddon-type recession is not in the cards. Maybe it's a softer recession. Maybe it's some kind of contraction that's not as painful. And even better than that, maybe it's not going to hit every single sector at the same time, because tech has already gone through its pain, gone through its cost-cutting cycle, and then this big run-up in price, perhaps leading a little bit and getting ahead of itself. But now the question is, does tech have to move down to meet the rest of the market, or will the rest of the market come up to meet it, the cyclical sectors and the stuff that has been unloved? If July repeats and extends into August and into fall, then it sounds like the cyclical sectors and some small caps will catch up, which, to Steph's point, broadening out is a strong indicator. I think we're still not entirely sure, though, what these lagging effects of the tightening cycle will be. So I'm not ready to jump in and say, okay, full steam ahead, but it does look stronger than I expected.
So is it also meaningful that everybody's been talking about the rally broadening out? The small caps are the hardest hit of all the indices today, down 1%. Where you see the Dow is just fractionally higher and the other two down about 1/3%.
Yes, but small cap value had a really great July, standout July, right? So anytime that you see such a swift rally like that, I think a little give back as a price discovery phase is normal. I don't know that I would put too much weight on what's happening just today.
Right,
I think some of it is just kind of, let's back off the gas a little bit in the stuff that's run really fast.